Welcome to Real Estate 360 Live with Ryan Sloper, the trusted name in real estate radio. Now, here's Ryan Sloper.
Welcome back, everyone, to another episode of Real Estate 360 Live. For those of you not familiar with the podcast, my guest and I will cover all angles of real estate, from interest rates to the economy to what's happening in Washington, the Federal Reserve. Anything that affects you and your real estate decisions will be covered here. Thank you guys for tuning in. We appreciate it. Be sure to either leave a review on iTunes, subscribe, share if you haven't done already the podcast through the iTunes platform. If you don't always have access to your mobile device, you can always go over to the website and stream it there if you're in your office at realestate360live.com. On that website, there's also an Ask a Question button. For any questions that you have regarding the markets, and it doesn't have to be real estate specific. Because remember, this show is all about pulling information from all over the place. It could be, economic, it could be interest rates, it could be credit, anything, and it will be covered here. We'll dive into it deeper, try to get you the answers. If I don't have the answer, trust me, I will find them for you. Joining me on our panel, as he does each and every week, is Louis Camrosana. Louis is a former school teacher, former attorney, and a former general manager of a major real estate portal. He's been cited as a real estate industry expert, Wall Street Journal, Forbes, Fox Business, U.S. News, Wall Street Journal, and numerous others. Louis, how you doing today?
Doing grand, Ryan. How are you?
I'm doing well. As I mentioned to you briefly, I've been trying to fight and get over this cold, but I have had the opportunity to kind of dive into a lot of the propaganda that the media is pushing out there. Week in and week out, we discuss these issues. I think the big ones for this week is we're going to kind of cover some of the breaking news and statistics. We had January headline retail sales at 0.9% versus an estimated 0.5%, so it's a little bit worse than expectations. But
that's
what?
negative 0.9.
Yes, negative 0.9% versus estimated of negative 0.5. So if we just look at that and we don't actually read their commentary on what's going on there, that's worse than expectations, right? If you X out auto retail sales, were plus 0.2 versus an estimated of negative 0.4, so it's a slight bump there. They go into detail of saying, well, it's partly due to the fact that gas prices are lower, and those are counted in the calculation. It's still a disappointment, but once again, it's not as big of a disappointment because they always have a reason for why something's happening, and now they'll start to blame everything on lower oil prices, right? This is going to be the mantra. I wouldn't be surprised if this rolls all the way through the summer. Now, we have seen, Louis, and I'm sure you've been paying attention to this, that the energy sector was last year one of the biggest job-producing sectors that there was. I believe it was something like 40% of the overall market on a previous podcast. So while everyone continues to tout the fact that it's great that oil prices are low, and when somebody goes to fill up their gas tank, instead of it being $60, it's $40, they have more disposable income, that most people are turning around and taking that money and just buying something else with it. They're not saving it. They're not putting themselves in a better financial position because of the lower oil prices. On the flip side of this argument, we have the oil and energy companies that are going out of business or setting themselves up to not have, they can no longer continue to produce oil at these levels. We talked about this before, but I don't really think people understand the magnitude of the situation. We have OPEC basically saying that they could keep oil at $20 if they wanted to. They have no intentions. A lot of the articles that have been coming out now that are finally acknowledging that this was intentional on their part to keep oil prices low. It's essentially international warfare that they created, right? They're not just affecting us, they're affecting numerous other countries, and they can continue to do that for some time. I think why it's such a big deal is because, once again, our job situation sucks as it is. Now we're going to have where there was 40% of jobs were going to that sector last year. I wouldn't be surprised if that gets cut by 50%, if not more. So to me, I look at it as it's a negative. It's a big negative. We're going to bring that back to real estate and mortgages. So sure. Do I think there's going to be a temporary bump this spring? I mentioned to you, Louis, that I thought there would be, right? I felt like interest rates, you get a tick down from 4.25 to 3.75. The people that do have access to capital, and I'm not talking about your lower middle class. I'm talking about the upper echelon, so the people that are probably making 150, 200 plus thousand. They've just been waiting for the time time to be right. Now is the time for them. But that's not the majority of the crowd, which is what you and I talk about all the time. So I want to get your thoughts, Louis, on the retail sales and kind of a little bit of what I just spoke about and the direction that you see things moving forward, especially with the situation of oil prices.
Okay, well, the retail sales were a disaster. And as you mentioned, they blame the oil prices. But if you remember, all the analysts, the cheerleaders, were saying that the lower oil prices, the lower gasoline prices, would be a boost, and they were a positive to the economy. In fact, they operate as a tax cut. It would put more money in their pockets, and they'd go out and spend because that's what the U.S. consumer does when they have cash. They're the resilient driver of the global economy because they spend money. Lately, they spend money on borrowed money, but now they've got this windfall, supposedly, that they can now spend money and boost retail sales with stuff that they buy that's imported from China and elsewhere. And, of course, consumer spending is 2/3 of the GDP, and therefore this was like a massive boom to the economy, which the media has been telling us is past recovery and is now accelerating, even though the rest of the world has no growth. The United States is a shining example of what QE can do and how we've reached escape velocity and all other nonsense that they talk about. But as you mentioned, we've said there's been a dark side. There is a dark side to the lower gas prices because the lower gas prices have now harmed the burgeoning shale oil business where most of the good energy jobs have been created in the past few years. And also there's a lot of derivatives and a lot of exposure there for companies that either can't make it or their hedges are going to have to bail them out because they're not making the type of money they thought they were making because when they modeled out their businesses, they were going to get north of $80, $90, $100 a barrel. And now it's down to, 50 and sub 50. So it hasn't worked out the way they expected, but that has not changed, Ryan. The media cheerleading, when I say the media cheerleaders, it's basically Reuters, AP, and Bloomberg. And once you do Reuters, AP, and Bloomberg, those are the stories that then get funneled out to CNBC and the other large media outlets, and that's what you call the mainstream media.
Right.
So when the job numbers come out, they view anything as strengthening labor market, recovery, if U.S. economy continues to improve, accelerated growth. They don't even look at the glass as half empty or half full. Everything is full. And then basically there's not even a glass there because the job growth that they're talking about, Ryan, is job growth. It's part-time jobs. And not only is it part-time jobs, a lot of people have 2 jobs, so it looks even better. But if you dig behind the numbers, which they never do, and we repeat on this show every week, the job growth is like 80% in the 55-year-old age group, and it's not in the top quality jobs. And now they're talking about they managed to get some wage growth in the last non-farm payroll report in January. The first time probably in a long, long time. But that, I suspect, Ryan, is merely a function of the fact that, if you remember, in November, a lot of states voted to increase the minimum wage. That took place in January. Okay, so there was wage growth because it was forced on a statutory basis, not because employers feel like they need to pay their workers more or that they can pay their workers more because the business is improving. No, it's because many states force them to pay more. Now, of course, when you're forced to pay more in January, what do you think happens? You start to lay off workers. Well, that's what we saw. You had a rise in initial jobless claims. But, of course, anytime you get a rise in initial jobless claims, you get the Reuters story about strengthening job market, it goes against the trend and so on. But when they had the retail sales numbers, Ryan, were astoundingly low because they come off a December which was low. Now, December is the Christmas season. Okay, so now it's 2 months. So now you can kind of say, well, it seems to be a trend, Bjorn. You think they might kind of give credibility to the fact that the numbers are there? No, what do they say? Here's the exact wording from Reuters. Still, cheaper gasoline prices, clinging to that concept, and robust employment gains are expected to provide a powerful stimulus to consumer spending and keep the economy on an expansion path despite sputtering growth in Asia and Europe. That one sentence contains all the propaganda, very skillfully done, talking about you got your low gas price, you got these robust employment gains, we have consumer spending that's going to continue, even though it isn't continuing. In fact, it's stopped and reversed the last 2 months, and we're on an expansion path, and the rest of the world has sputtering growth.
They're living
and then
in
it says it's expected to maintain the pace of growth this year. Then they had a quote, should we be worried about weakness of underlying sales the past 2 months? Possibly. This guy, chief economist of Capital Economists in Toronto. But all the conditions are in place for a period of very strong consumptive growth. We still expect to see that strength come through in retail sales data soon. So again, in the second quarter, it's going to happen. The recovery is always just a moment away, or they claim it's already here, and then when it's obvious it's not here, well, it's coming.
Yep. I mean, you got it right, though. It's like Associated Press, Reuters, Bloomberg. They're painting this fairy tale world, right, that they want people to buy into. It's the hype, and there's never any actual sound, foundation for them to base any of this off of. It's just the storyline that they have to continue, right? I mean, this is exactly what the Fed has done for some time now. They don't ever really have to give a reason for why things are happening. It's just that they'll, we'll see how things go. I mean, this has been going on for 5+ years. They have not been able to stimulate the economy at all. If anything, there's more and more stories coming out. I don't know if you saw, Lewis, but there's this big up in arms that Bank of America basically was funneling money overseas to London and basically making risky bets with basically people money that they were depositing into their Bank of America account. They were shipping it over to London and allowing them to basically invest in stuff they weren't supposed to be investing in. Have you seen anything about that case?
No, I haven't.
Oh, it's going to be a disaster. And they've already started talking that, basically Bank of America is one of the biggest banks for doing stuff, that's not above board. And this is going to be another one that's really, I think, obviously is going to hit the fan, but it's not a big deal because the Fed's there to backstop them. They're not going to let Bank of America go under. They're going to fine them for $50 billion, and everything will be fine tomorrow, right?
Right.
And this is, it's sad because that's kind of where we're at. And David Stockman was actually the one that wrote the article, but he goes in, he starts the article with mainstream narrative about recovery from the financial crisis, a giant con job. And so right there, David Stockman pretty much for mainstream media loses all his credibility, okay? Because it's not in line with the recovery that they're peddling. He's completely against that. And this is common for anybody that's actually speaking out against what's taking place. You and I have said that, isn't it interesting that we probably have one of the least productive societies right now. Now, I'm not talking about innovation and technology and stuff like that. That's advancing at a very rapid pace, and exponentially it's growing, right? I mean, we do have a lot of things coming to the market, but it doesn't mean that they're actually these companies are actually producing profit, which is something we used to care about. And talk about this time and time again, Louis. It's great that we can have Bank of America that can lend money to these huge hedge funds that can then invest to these startup companies that all they're worried about is a future valuation based upon user base, but not profit. And the everyday average American, that's all that we really have to work off. A small business works off of profits, not what it's going to trade at 5-10 years from now. And exactly, and everybody wonders why we have this separation of classes that has taken place over the last 5+ years, right? I
mean, you look at it, if you live in the San Francisco Bay Area, that's exactly what it is, because you have people walking around making hundreds of thousands of dollars or millions of dollars in stock options off of companies that don't make any money, never will make any money, yet they have valuations that are ridiculously high, and they're there because that's what Wall Street rewards. They don't reward a profit, they reward a growth story, and it's basically Silicon Valley sells it to Wall Street. And when you have that dynamic, that's a disaster for a crash because we saw it in the dot-com bubble. At some point, people wake up and they say, why do I own this company? It's going to what? It's 5 years on and the company hasn't made money. It's 10 years on and these companies, some of them haven't made money and never will make any money because they're not even focused on making money because Wall Street doesn't want them to make money. They're focused on improving their other metrics. Well, and that's a shame of the economy, because that means all the money that could have been invested into productive, profitable endeavors hasn't happened over the last 5 or 6, 7, 8 years. All that's happened is big money is poured into these types of companies that arguably don't really add any value to society. A lot of them are just entertainment, so people can play with something on their iPhone. Doesn't make them more efficient, doesn't make them more productive. In fact, it probably makes them less productive because they spend more time staring at their screen than doing actual work.
Oh, hold on, Louis. Are you like referencing maybe a site like Zillow or Trulia where you can go on there and play around and see what your home values are?
Well, for real estate, we can use them for an example, but I'm sure there's a company or two or three in every other area of the economy. But if you look at Trulia and Zillow, right, what do? They provide a bulletin board for people to go and look at real estate information. Wonderful. Neither of those companies make money. They've been in business since 2005, yet I think Zillow has a market cap well over $4 billion. Trulia probably has $2 billion. So there's all that money that's flown into that sector, and they've been around for 10 years. And where's the productivity? I mean, they're great companies. They innovate. It's interesting. You spend a lot of time on the site.
Yeah.
And they either sell Netflix ads or they try to sell leads to real estate agents.
Well, and you know where the productivity is actually happening? It's happening on the ground. It's the agents that are actually finding the houses for these people. Now, great, it helped them find a house online, but I just had one this past week, Louis. Client calls me, hey, I found this house on Zillow. Can we please go check it out? I said, did that one come up in the automated search that I've set up for you in my MLS? No, it didn't come up. I said, well, I promise you it's probably either under contract or already sold, right? What everybody forgets is that the information is not real time. This is syndicated from the MLS and gets pushed over to these sites.
The more information they have, Ryan, then the better they do, and people are going to find it because Google likes to see a lot of information. So if they were to remove all those listings, there'd be less information, and they wouldn't be viewed as well on in the search engine results.
Well, do you know what I always tell people when they tell me, hey, yeah, so I went on Zillow and they told me my house was worth $400,000. I was like, great. Did Zillow come out to your house and inspect your house by any chance? I was like, and they went, what do you mean? I was like, well, do they know what's inside your house? Your house could be falling down for all I know.
Right. Well, the CEO, I mean, they have, when they first came out, they were trying to say that their estimates are getting more and more accurate, and they're basically the be all and end all. They've changed the tune, and to their credit, they say it's a starting point. They even do a calculation so they can be off as much as, and they name a percent, which I think is double digit. So basically, they've moved away from that as the circus tool as their main draw for business, and they focused on listings. But the underlying point, Ryan, is that the real estate market sales over the last 5 years have been flat. So if sales have been flat and they make their money on selling ads to real estate agents who make their money on selling real estate, and they're not selling as much as they were 4, 5, 6, 7, 8 years ago, why does the growth continue? In the stock price. I mean, what are they going? Are they going to sell twice as many homes next year? No. All of our projections show that sales of homes, new homes, and existing homes are flat and will remain flat for the next couple of years. Are they going to get more traffic? No, because they already have all the traffic. So where does the growth come from? Wall Street doesn't care. They can always show some growth, and then the stock market, the stock gets rewarded.
Well, and,
for how
and
long?
And once you get to a point where you feel like the growth may be stalling out, you just acquire another company.
Well, that's what they did, sure. Now the talk has been for the last year, while they're getting regulatory approval, about all the synergies. So now they have another 6 months where the two companies get together, where they get a honeymoon, where if they don't show results for the first 6 months, it's because they haven't quite put it all together. They come up with some synergy after that, and they're off to the races for another year.
Yep.
Because now they can show they're double their size. So that's what's on. It used to be banks, Ryan. The way I think of banks, they were very prudent. They were stewards of your capital. They wanted a return on investment. And now they're just trading casinos. No, because a prudent bank would never invest in companies that are not profitable. I saw a thing the other day that I think 70 or 80% of the IPOs that came out last year or recently are not profitable. When I was a lawyer 25 years ago, it was unheard of that you would bring a company public without a profit. Why would the public want to, well, now the concept is you get it on the ground floor. But we've seen these companies. You got it on the ground floor in Zillow in 2011 before they made a profit. Well, it's 2015. Right. They haven't made a profit. They're not even projecting one, and Wall Street isn't harassing them about that.
Well, would you not agree that a true and prudent bank in the first place, a depository institution that would be backed by the government and an insurance, should not be investing in anything, period, other than businesses in the forms of loans, right? Not like risky investments and being able to loan hundreds of billions of dollars to hedge funds that are then reinvesting their money back into the markets.
And into companies that don't make any money.
Yeah, and I think that this has been the big thing. We're worried about where companies are going. I know you saw this, but Radio Shack just laid off another 1,700 people. They're going into bankruptcy, right? This made the headlines for about all of a couple hours, I think, and it's now being swept back under the rug. Who wants to talk about Radio Shack? They've only been around for how long?
Since they survived the Great Depression. Ryan, Yahoo front page yesterday. You're talking about sweeping things under the rug. Yahoo Finance front page. Yesterday, we had initial jobless claims that missed in a big way. You had consumer spending, which is that is the holy grail for most economic cheerleaders, was down nearly 1%. And within hours, those stories were not on the front page at all. They had the two head stories were, here's what can slingshot the Dow towards 20K. And the next story was why you should own Apple. Okay, these aren't stories. The story of the day was consumer spending missed by a massive amount. That's the headline story. Now, what happened to the stock market yesterday on this news? Went up. Why? It doesn't matter. It goes up every day. It's supposed to go up. The jobless claims were poor. The consumer spending was down. The durable goods last week were down. They are still highlighting the one piece of economic news that they can say was good was they had a non-farm payroll last week which showed job growth. What kind of job growth? Doesn't matter. There was a top-line job growth. And there was wage growth. That means the U.S. economy is accelerating. It's solid. It's robust. It's on economic expansion. It's accelerating. Forget all the other statistics.
Yep.
And then the stock market goes up.
Yeah, you're right. I mean, and we've talked about this, at length on all the previous podcasts that literally we could have retail sales that are horrible. Jobless claims are up. We could have, basically no wage growth for 4 to 5 years. But we have a low interest rate environment, and we have a rising stock market, so everything's peachy, right? And you don't even have to explain why. You just say because you have a low interest rate environment and you have a high stock market. It has to be a good time.
Well, it used to be that home prices were rising and you had a high stock market. Now you don't have home prices rising. You don't have home sales. Well, okay, we'll forget about real estate. Real estate was never that important. Of course it was. That's what they touted was the main reason to do QE was to boost housing prices so people would feel wealthier. They go out and spend money. They get their equity back in their homes. Well, that stopped happening. They don't care about that. Now they know the focus is on the stock market.
Well, Louis, when I got in, and I actually got into the finance business first back in 2002, I remember my dad, very vividly, always telling me kind of the relationship to the 10-year bond, watching stocks and the reaction to how they relate to mortgage interest rates. And technically there was never a true relationship where if stocks were going up, basically, the 10-year bond was getting worse in the other direction, right? But you would see that there was patterns that stuff would happen for the most part.
Right.
The stock market was going up, then mortgage interest rates would be getting worse, right?
Correct.
But today...
Now they go together.
They go together, which is exactly why you know that it's screwed up. It's fake, right? And nobody ever actually questions that. And I'm always curious as to why. We have statistics that show how many times they were basically moving in opposite directions, and now everybody wants to just say that, there was really never any relationship between the two. Yeah. And I can actually argue that, okay, if you have a rising stock market, everything is is going the way that you would want it to, that the mortgage interest rates go higher naturally. They should. But the fact that they want them to go lower, and
because the cost of money, because if people are doing well, then money is more expensive because there's a greater demand for it.
Oh, and I forgot to mention the best of all, Lewis, is because now it's not good enough, like, for the stock market to just be high, to have a low interest rate environment. The economy is recovering at such a rapid pace that I need to scale back expectations for people of what they need credit score-wise to be able to get a loan. So if you're at 640, who cares? You only need a 600 now. Let's loosen up the guidelines all over again because we're recovering this economy, right?
Why do you think the car sales are higher? Because it's easier to get people into cars than it is into homes, because a car payment could be $500-$600 a month, a mortgage payment $900. So you can't afford the house, but you can still afford a car. So I did an article, it was published in the news, that talked about the flat home sales during the recovery, but the soaring car sales. And it's obvious what's happening is that car sales are back to historic highs. Prices of cars are at all-time highs. Now, you wouldn't expect that. You'd think, well, maybe they had to lower the price to get more people into cars. No. They just hand out loans to anybody, 7-8 year loans, no money down, credit score doesn't matter. That's what they do to sell cars. The real estate industry is furious because they can't seem to get that kind of deal out to their customers. Right. And there's a reason for it, because it's a lot easier to come and repo a car, than it is to come and kick people out of their house in foreclosures. And they can also factor it in. I mean, if they're selling the cars for an average of $35,000-$40,000, there's probably some profit marked in there, and there's probably some profit marked in of the people who are paying on their car loans that they could take a haircut. It's just like Milken's junk bond analysis, where you buy bonds with a higher yield and a lower yield. Sure, some of them are going to default, but on average, your portfolio will end up with a higher yield. So that's what they're doing. They figure subprime, sure, a lot of people are going to default, but we'll make a lot of loans. That is the case where you do make it up on volume.
Well, are you ready for this one, Lewis? I figured you'd appreciate it because I've been talking about this, about 2 years ago, that I said, just give it some time and we'll have the official subprime back. Well, it's back.
It's back, yeah. But it's not working, though.
Well, it's not working, but I'm going to explain to you why it's not working. You ready for this?
Okay.
I want you to hear the rates that are being charged in order for you to get these type of loans. So no short sale seasoning to 75% loan to value. Short sale 2 years old, 85% LTV, even with a 500 credit score. Don't get caught up on new agency rules. This is the highlight of the program, okay? Fund your short sale loans easily. I'm not going to tell you the company because it's really irrelevant at this point. 80% loan to value, 2 years outside foreclosure and bankruptcy, no prepayment penalty, bank statements for income to 80% loan to value, $2 million loan amounts. And then I go and I click on the rates. Okay, great. Let's see where the rates are. Credit grade. And let's assume that you've only got a 500 FICO, which is credit grade C. And remember, this is irrelevant. I'm not quoting rates or anything. This is just off of somebody's sheet. So there's obviously going to be a lot of terms and conditions on this. I'm just going to give ballparks here. You're at a 65% loan to value, so putting 35% down with a 500 FICO, your rate would be 9.75%.
Whoa.
Okay? Oh, so you mean if I'm going to lend to somebody a 500 credit score, then I need to have a rate high enough to be able to lend to them with that kind of risk? Yes, of course you do. But do you think how many people at a 500 FICO have 35% to put down? And how many of them are going to take a rate of 9.75? They're not.
No.
They're not. So everybody thinks that it's just a matter of, okay, well, we just need subprime back and that's going to take care of the problem. No, it's not. We actually have to fix the underlying issues, which will not be fixed as long as this continues. We're not, and you brought up some wage growth too, Lewis. I thought about this because, as I mentioned, the staffing companies are growing at a rapid pace right now. A lot of it to do with, the Obamacare issues and basically companies just wanting liability and passing that through to the staffing agency. Companies can't actually afford to pay a little bit more wage-wise when they don't have all the other crap to deal with, right? So I would suspect that we might see a little bump in wages. I don't think we're going to see as many jobs being being brought on, but I feel like some of the wages might start to get increased because the companies, especially if they're contracting jobs out, they don't have the same liability that they did before. They might be willing to pay a little bit more to get somebody of a better quality.
Sure, but if you look, Ryan, if you factor in also what companies are facing, if they have lower sales, that means that their expenses relative to sales are going to be higher. So there's a cap on how much they can raise salaries, even though there's some cost savings in the dynamic you just explained, because they need to show profit growth because that's what supposedly drives their stock market. There are companies that do rise because they can claim per share profit growth. And the way they get that, of course, is you saw Pepsi just announce a massive buyback. And the Wall Street cheers that. So the dynamic for wage growth, there's still a cap on it because even the dynamic you described isn't because of better economic circumstances. Mm-hmm. It just happens to be, well, maybe we can pay a little more here. But there's a cap on how much more they can pay. The only way that wages can actually increase, Ryan, you know this, is if the company is selling so much of its products and services and that it actually needs to bring on more employees. And it's also worried about losing its existing employees because of competition, that it has to raise wages. That's certainly not the dynamic right now.
No, and also they have to be not caught in a situation where they're actually having to lower the price to sell more, right? Because it's not like a lot of these companies are actually have products and services that are so much more attractive or productive that it warrants a higher price. I mean, a lot of the and look at with the age of Amazon, right? It basically flushes 90% of these stores out of business immediately because they
and with Walmart.
They're a publicly traded company who's willing to take a loss on the front end. They'll go negative $200. They've already said that that's their model. Their model is to acquire the customer and hold them long term.
And to sell them more, even if they sell them more at a loss, because Wall Street likes to see that revenue growth and customer growth. Doesn't matter if it's not profitable.
So they can come up with, more innovative ideas such as having drones drop off box on your front door with the use of the public's money.
Yep. And the public is willing to fund it because if you own those shares in those companies, it goes up. So it's not. It used to be, Ryan, investing was you took a loss or you held on to a company for a period of time at the initial stages until it made money. And you were taking a great risk because the risk was you put money in the company, it was losing money while you put it in, it continued to lose money, but one day it was going to become profitable and then you would reap the rewards. Now you reap the rewards directly from companies that lose money. You fund their losses, but you don't lose anything. You gain in stock appreciation.
Right. Yeah. I mean,
that is about as backwards as you could possibly imagine. And in fact, the VCs are already out before the company ever turns a profit. They've made a fortune. The early investors in the IPO, even the investors in the post market, they make money. But the company never makes money. So how is it that all this value has been created? All these profits have been created from a company that never made a dime.
It's the $1 million question.
But that's what our economy is based on.
Yeah.
And we keep churning that out. That means all that money that was made or could have been made or invested in never went towards a company that actually could have produced profits and jobs that would last.
I mean, you're 100% correct. I mean, these aren't jobs that were set up to, help strengthen the infrastructure, right? Like without the government being involved to try to just say, hey, we're going to lay out a plan where we have $800 billion and start building better roads. That's their idea of pumping the economy up, right?
Well, that's all they can do.
That's all they can do is to add more debt, have the Fed print more money to backstop it. And as we mentioned, Louis, this has been going on for 5 years. You and I have go debating back and forth as to when it's going to end. But I did want to bring up that it's interesting because there's been a couple people. Everybody's familiar with Warren Buffett. There's been a lot of people calling major declines in the stock markets are surely coming down the pike. Now, you and I have been saying this the whole time, mainly because of what we mentioned just a second ago, which is they're actually not producing anything of value. They're not really turning profits. They may be gathering a bigger user base. They may have more eyeballs on their website. They have more users, but they're not making more money. They're not.
They're making more revenue.
More revenue, but they're not the bottom line profit.
Nope. There's no bottom line profit. In fact, the bottom line profit, actually, they go further away. They'll get rewarded for growing revenue and having a 6 cents a share loss. And then the next quarter, if they grow revenue 10%, but then they go to a 12-cent loss, even though they've doubled their loss and only grow revenue 10%, Wall Street will reward that too.
Well, you know what?
They're building for the future.
Yeah, and I'll give you a great example. So, my dad and I have been investing in real estate for some time now, right? And everybody that's been listening to this podcast knows that. So we have what's called a commercial line of credit with the bank. And they basically give as a line of credit to buy properties. And so let's just say that I'm making up numbers to keep it easy, but $1 million line of credit facility where we can go out and buy properties. So we find a property, they'll lend it to us, basically money at about 70%. So we got to put about 30% down. We're in charge of doing the renovations. It's essentially a 6-month loan that can be expanded out to 12 months. Well, every year you have to renew this commercial line of credit. It's not like a residential loan where you can keep it and then, until 30 years is up, you don't ever have to show any more.
Right. It's a revolving credit line that gets renewed in your case, on an annual basis. Okay,
great. So now let's assume, Louis, that our revenues have been increasing, right? Year over year over year. But our bottom line profits are just barely inching up, not as much as we would like, right? And mainly due to a more competitive real estate market that would kind of make sense, right? We're having to buy houses a little bit higher than we were before. The margins are a little bit thinner than they were before, but we're still turning a profit. Well, guess what? When we go to renew our line each and every year, they're like, oh, well, you're not really getting to the level that you want. Oh, what's the level? We've always made our payments on time. We've actually got more revenue in the door. They don't, you know what? The local bank, they don't want to lend to us.
Why should they? They don't care what your revenues are. That's not a metric that pays them back.
Absolutely. So
it pays. So you should go to Wall Street, right?
That's what you have to do if you want to basically, and that's exactly what these hedge funds are created for. If I remember correctly, I was reading one of Donald Trump's old books, and it was basically like, he came up with the idea to basically buy properties in certain states at a distressed price. So he puts together a $200 or $300 million fund. He has no liability in it. All the people that invest in the fund do. He gets to keep 50% of the upside. And, that's exactly what's taking place. But my point is more to the average consumer out there, average business person. This is why there's no growth in the economy, right? So because even if you're doing everything you can to push forward, the banks want to continue to make money hand over fist, but they don't want that passed down to what I basically.
Well, lending money is a very manual business fraught with risk. When if you can just trade derivatives and whatever else they trade, and you have rigged the game and the profits are immense, why bother with the bricks and mortar mom and pop loans and worrying whether they're going to pay you back, whether the business is going to succeed? When in an instant you have a rigged trading game, you've seen the statistics where J.P. Morgan, Goldman Sachs, all these companies, the percentage of wins on their trades are astronomical.
Yep.
And it's not like it's 50-50 or 60-40. They win almost on every trade. It's like a big deal when they lose on a trade, like with this London whale thing. Make headlines that they actually made a bad bet. Because normally they know exactly what bets to make.
Yeah, because
they put huge amounts of money into them.
Right. Yeah, well, you got the high frequency traders. You've got
right.
the ability to throw such large positions on both sides that you maybe make a cent, 1 cent, 1 cent, 1 cent, all day long. Times millions and millions of trades. Yeah, it adds up.
Well, they want to lend money to you and your dad, and they want to spend time to sit down with you, talk to you, and then hope that you're going to pay them back. That's not even worth their time.
Well, and it's not even stopping there, Louis. It's providing 3 years of tax returns, explanations from CPAs. They want stuff that they know it's very difficult to get so that they can just sit back and say, you know what, we'll lend to you, but we're not going to up your credit line, right? We're not going to do anything that's going to really help you grow.
Well, why would they put more capital at something that has it's relatively high risk and very low return. How much money do you make on a credit line to a small business?
Well, you figure it's prime plus. I believe it's prime plus 2.
So what?
Yeah, so you're in the 5% range.
That's nothing compared to the amount of money they make trading.
Well, I think the bigger point is back when we actually had an economy that was built on something actually real and not artificial, that banks did care about helping.
Oh, they would be seeking you out. But right now, the way you make money, especially in the United States, in other countries it's not the way, is you make it through financial services. And they're not services, it's trading. And you make it through IPOs and you make it through company stock appreciation, but not through creating companies that produce profitable value.
So do you think that we'll ever get back to where we actually care about real businesses?
Well, it's hard to say because, Ryan, if you look at the percentage of the United States GDP that's in financial services, it's on a percentage basis, I think it's like 30-40% now. It used to be 5%. Banks are supposed to be in the background lending money to companies that actually move to the foreground because of their profitable status.
Yep.
They're not. The banks themselves aren't supposed to be the largest driver of the economy. They're just supposed to be, or in terms of revenue, they're supposed to be the ones that kind of fund the economy, not are the economy. And that's what they are now. They are the economy. Yeah. And then they have the too big to fail, so of course they can't fail. It used to be if a bank failed, all right, the companies could still do well because they were still making money. You still need a banking system, but you don't need a particular bank. But now the banking system is just 4 or 5 banks in the U.S. and a few in Asia and a few in Europe.
Yeah, and
that's a systemic risk.
It is. It's a huge risk, but nobody really cares. Nobody really cares other than you and I and a few select others that this is taking place. And people think that this is something that doesn't really exist, that things really can't take a turn for the worse. And I always tell people, like, I feel like I'm having the conversation on a daily basis, Willis, that how history repeats itself. It's just in the last 10 years, it's been repeating itself at a more rapid pace.
Yes.
Right? And that's very scary for that to happen because it's essentially saying that you're not learning from your mistakes. You make the same stupid mistake over and over and over again. And, it is insanity. It's exactly what it is. And nobody wants to actually confront this. Nobody wants to confront what's actually taking place and saying that the stock market is reaching astronomical levels, that gold and silver prices are being suppressed intentionally to give the illusion that the economy is actually fine. But it's not. It's not. And I, unfortunately, have to be the guy that's out there in the real estate business that's giving this dose of reality to people, and they sometimes look at me like, okay, well, why would you tell me that? That's almost like you're incentivizing me to not buy. No, it's not meant to incentivize or sway somebody's decision to buy or sell their real estate. It's just meant to say that you need to be making a decision based upon, to me, the overlying fundamentals of the economy, right?
When you have this financial repression where basically they tell you and they create the environment where they force you into certain assets, like you cannot have a CD because it pays no interest, so you're forced into stocks, and it's in the area of the economy they want to go up, so stocks go up. Same with housing. They try to force you into housing. I think, Ryan, what people don't understand is that it is so precarious. That's why it's all based on confidence. It's not based on actual profits. The economy isn't doing well. It's based on statistics being put out there, spun, and people being told the way things are rather than what they actually, as you call the eye test, see things as they are. And as you know, propaganda is very powerful. You can get people to actually believe a lie if you repeat it enough, and that's an old expression from one of the Nazi propagandists. You start to believe it yourself if you're the one propagating the lie. But the economy is clearly not strong, and yet they continue to claim that it is. It's accelerating, and it'll be a total surprise, just like the last financial crisis, when it happens. When anyone looking at it with half a brain knows that the job growth isn't there, if you just look at the job numbers, they're part-time, There is no real wage growth. They try to claim that the lower labor participation rate is due to boomers retiring, which is absolute nonsense. They're actually getting more jobs because they're not retiring, because they can't retire on fixed income because interest rates are low, and they don't have the money. So you see aging boomers in grocery store jobs, Home Depot jobs, and so on. They take up the bulk of those jobs. That's where the job growth is.
Well, it's interesting, and this is why I always say the eye test, and or at this point you could say the smell test, because if it smells like you know what, it typically is, right?
Right.
And my grandmother, for instance, has when my grandfather passed years back, she had basically a lump sum of money. Most of her money was invested in CDs. So there for a period of time where she was able to make like 3% in a longer-term CD. It was enough money in addition to her Social Security to have her where she wasn't having to eat into her nest egg at all, right?
Right.
But guess what? The last 5 years it's getting depleted, and she's getting worried, and she's asking me. She's like, Ryan, I'm scared that I'm going to outlive my money. These are real things, guys. Like, and I'm telling the story because this is reality. This isn't what people are out there telling you. Oh, they're fine. They're going back to work now. My grandmother still works. She's 82 years old. She still goes to work, but she doesn't get paid. She's doing it as a volunteer. Right. She's doing that to keep herself just going, right?
Yep.
But she's scared. And I have to give her reassurance that, you know what, don't worry about that. We're going to take care of you, okay? But not everybody is in that position. Not everybody's in that position to be able to take care of their grandmother, right? And that's what's scary to me is that this system is crushing them, forcing them to go back to work when they were said that it was going to be okay to retire when they were 65 years of age. They don't have any money being made on CDs now. They're going negative. The rents are rising. These are real facts. And you know what? It's only going to get worse.
And right, if these people have to go back to work, then what they're doing is they're denying the younger people. They're competing with the younger people for entry-level jobs. That the entry-level, the younger people should be taking those jobs, getting their first work experience. But instead, they're not, either because they're competing with aging baby boomers or older, or because they're in school taking on debt to go to school because they're told that when they graduate, they won't have to do these jobs.
Right, where's the headline?
Well, wrong. They come out, and then they're in line with Grandpa for the job at Home Depot.
Yeah, where's the headline? Millennials upset, jobs being lost to baby boomer, right?
Well, there is this kind of, not class warfare, but I hear a lot. Millennials telling boomers that they're selfish, and boomers saying that the millennials are lazy. This is ridiculous because those aren't traits of a generation. Boomers aren't selfish. Millennials aren't lazy. They're put in an economic circumstance where boomers are paid into Social Security, so they expect to get it back. They were forced to pay for it. That's not selfish. They're not asking the younger generation to pay for the Social Security. They have no choice. That's what they had to do when they were younger. They paid for the older people. And the same with millennials aren't lazy as a generation. They're in a position where, well, when you owe money and you don't have a job and you're told that, going to school is going to get you a job and you don't get one and now you don't work, that doesn't mean you're lazy. It means that's the circumstance you're in.
Well,
but they've created this whole millennial versus boomer thing where somehow millennials are insisting that their problem is caused by boomers. No, it's caused by the circumstances that the vast majority of boomers had nothing to do with setting up. And boomers shouldn't call millennials lazy because they're not lazy. They're a product of what's happened in a situation where they've boosted asset prices out of the price of millennials' reach. Now, boomers have benefited from that because they were the ones who owned the houses. They got bailed out. But they had nothing to do with that.
No. And you know what, though? I gave you an example of my grandmother, but there's other boomers that instead of – she's so conservative, she wouldn't put a dime into the market if she could, right? So right. She won't do that. So she will just let her money be depleted over a period of time because she's not worth gambling any of her money. She just won't do it. But there's other
– she's worried that one day, and it's going to happen. We don't know when. The stock market is just going to – people are going to wake up, and it'll just collapse. They'll say,
Exactly, and that's my point, is that there's the other boomers that have decided that, you know what, I'm just going to have to risk this. I'm going to have, in order for me to live and survive, I'm going all in the stock markets. They've been riding this train up. But what happens when it just collapses?
Can the Fed, Ryan, I asked this question on my site. I got about 1,000 responses. Can the Fed actually reinflate this thing if it crashes again? Do they have the amount of cash without creating some massive, even greater distortion in the economy, like massive inflation, if they had to reflate the stock market?
Well, my answer to you would be is that I wouldn't put it past. They've proven us wrong before.
But you think they could pull it off this time? And they did pull it off. You look at 2009, I thought, they'll never get stocks back up because the economy won't rise. They got the stock market price back up. They didn't get the productivity of the economic gains. They got the stock market back up. I'm wondering whether they could even get the stock market back up next time.
Maybe. I mean, I think that there's going to be something else that's involved, a bigger diversion, as we always talk about. But yeah, I don't know. I don't know. And the bigger question is instead of it collapsing and trying to get it back up, can they continue to push it higher if I continue to just do what they're doing? I don't know. It's been going on for so long. I think I've come kind of just I just have to wait and see how it plays out. You and I always, have our predictions, but they've proven that they've been able to outlast almost all of the people out there that are saying that bad things are going to take place 2 and 3 years ago.
Yep.
And so for that, I give them credit for being the Wizard of Oz that is able to manipulate the system to the point that they have. But overall, you and I agree that this is not good. And we would have been better off, or at least in my opinion, and people think I'm crazy when I say this, is we should have just let everything fall to its face and rebuild from the bottom up, even if we call it a depression of some sorts, because you can come out of those times a lot faster than you can.
You restructure.
Yeah, restructure. Actually have banks that are not allowed to invest in risky things and build it from a solid foundation where they're just a bank. That's it. They're not allowed to become an investment channel. That should be illegal.
And you can have those types of banks too. They just don't mingle the depositor money.
Absolutely.
And you clearly don't insure that activity by the federal government, which is what they just passed late last year.
And that's what Bank of America is doing now, and that's what I was just mentioning earlier in the show. Bank of America is doing that, which is no surprise that they're doing that because their buddies are there at the Federal Reserve. And so, like I said, what will happen is they'll come in, they'll get their hands smacked, they'll pay their fine of $50 billion when they probably have siphoned off $150 billion. No big deal.
Cost of doing business, right?
Yeah. Unfortunately, Louis, apparently you and I don't have good enough buddies at the Fed that we can just get them to, just bail us out whenever we want, or just give us money and we don't really have to worry about paying it back.
Right.
It'd be nice. We should probably start trying to talk to Yellen. I think she would appreciate your accent that you have of imitating her.
Monetary policy.
Yes, I think that you and her would have a delightful conversation over some tea.
I'm sure she's a delightful woman. These people, most of them, have to be somewhat, she's not charismatic, but they have to have some political skills and likability skills to get these jobs.
Yes, or they're just there to just continue to be that order taker, right? They're given instructions and they just do what they're told. I feel like that's what's actually more the case than anything else. The question, Ryan, is who is telling them what to do? Or is it Congress, as it should be, or is it the shareholder banks, or is it some combination of the two? Who do you think calls the shots at the Fed if it's not the chairman? 100% the banks. 100%.
Do you think Congress has any input in?
No.
Okay.
None. I think it's 100% money calling the shots. It's the wealthy, it's the uber rich throughout the world that are calling the shots right now. I don't think Congress can do anything. It's so far gone and past them. I'm a firm believer in this at this point.
I believe with you directionally, but I think that the Congress actually does control the Fed, but they control them because the banks control Congress. So it's the same thing.
Right. So
but I think most of Congress wants or puts up with whatever the Fed wants to do.
Yeah.
Because most of the congressional members, there's a bank lobby. And so they vote with the bank.
Yeah, they
now,
have.
when you have guys
right?
like Ron Paul, Rand Paul, not Elizabeth Warren, because she's not even in favor of auditing the Fed. Those people are not the majority of Congress that want to take away power from the Fed.
Yeah, but you know what?
The concept that they're to remain independent and all that, that's because Congress has delegated that authority, and they're comfortable with it, not because they're comfortable with the results that they're getting. Because what the Fed does, Ryan, when it provides cheap money, that helps a lot of politicians get votes.
Of course it does. And you know what?
So they're in favor of it.
Well, and then if things turn bad and you have one of these politicians that are out in front of it saying, see, I told you we should have audited the Fed. Nobody else wanted to listen to me, right? You're going to get some of those people that actually say these things and don't actually believe it. And then you actually do have a few that actually believe it, and they just can't get their way because there's not
Well, you
enough.
see what Liz Warren does. She jumps up and down, talks about the problems with the big banks. But when it comes to auditing the Fed, she's out there hugging Janet and saying, no, she's in control. Let her do what she's going to do.
She doesn't have a clue. She doesn't have a clue.
Well, that's all just for show then. That's just to get people riled up. But when push comes to shove, she doesn't want to do anything.
No, and this is at the end of the day, this is where it's always going to come back to, okay, can the banks continue to just be able to pump this thing higher? Because I think that what the telling thing that will happen is if the market starts to recheck, the stock market starts to pull back, and people start to get scared and start pulling money, that's when we'll know if the Fed is able to start manipulating things to not let it happen, at a 50% clip. You know what I mean?
Here's the thing. It happened. They do have experience now, but they did lose control of the game in 2008. And supposedly they were half an hour, 2 hours away from complete financial meltdown. Now, they may know how to react better, but the problem is bigger. Are they up to the task if this happens again?
Only time will tell, Louis.
Yeah, but I think it's bound to happen again because it's just so big.
Sure.
It's like trying to control nature or a hurricane.
Yeah. Yeah, I mean, and the natural forces at some point do.
Well, look at Katrina, right? They built up the levees. They thought they were high enough. And look at Fukushima. At some point, these things get bigger than you can control, no matter how big you build the dam.
Well, I agree. And you know what? We always come back to the point. It's the same with currency, right? There's never been a fiat currency that has never become extinct at some point, right?
So because the dollar would be that currency. And if they allow it to be the strong currency, and the Fed doesn't do QE, and the Fed does raise rates, the dollar will become the premier currency. But that the Fed won't allow the dollar to go over 100, 120 on the DAX because it would cause so much distortion in the U.S. and global economy. So they're going to have to do something like not raise rates or do QE4 or something kind of spending to drive the dollar down. They won't allow the dollar to reach its natural strength.
Now, don't be surprised if you see the next round of whatever they do, they get away from the two-letter QE and create something else, because I think that
they have to add liquidity to the market, which means to take away some demand for the dollar. Because right now the demand for the dollar is strong, and it's only going to get stronger if the Fed continues to talk about raising rates. Yep.
So as we always do, we'll just continue to see how it all plays out. We're up on the end of the show. I want to thank you for coming on. If you wouldn't mind, give our listeners your blog and also direct them to maybe where they can check out that the blog post that was posted up to the Inman site as well.
Oh, sure. It's I have that blog post also posted on my site, the one about rising rising car sales versus flat home sales. It's all on smoggled.com. There's up to 2 or 3 or sometimes 4 blog posts a week on the economy, real estate, economics, and gold and silver analysis as well. So please check it out. It's smoggled.com, SMAULGLD.com. Thank you.
Thanks, Louis. Appreciate it. Thank you, guys.
Thanks, Ryan.
And don't forget to leave a review on iTunes, subscribe, share with your friends. Also, you can go to realestate360live.com and ask a question on there as well. Take care. Until next week.